Foreign investors have pulled out $1.68 trillion out of India in 4 months.
A gap down opening, as you had pointed.
$100 after Iranian strike.
A fairly decent.
That's not a typo. That's a number large enough to fund India's entire defense budget twice. So here's a question: how one geopolitical crisis triggered a chain reaction and whether India's 3.9 trillion economy is about to pay the price. Let's dive in. The Nifty 50 fell more than 13%. The Sensex dropped over 700 points in a single session. And let me tell you this, that March wasn't a one-off. To put it in plain English, the world's largest investment funds are hitting the exit button on India, and they're doing it at a pace we have not seen before. But here's what's interesting. India's domestic investors, or the DIIS, actually bought 1.28 lakh crore during the same period. That's historic. So who's right? The global funds running for the door or the Indian investors staying at the table? That tension is at the heart of today's story. The Pahalgam attack of April 22, 2025 was a turning point. The images went around the world in hours. India's public mood shifted from shock to fury. And the government responded with Operation Sindoor, a military strike, precise, decisive, and designed to send a message. Now let's try to flip the lens. The geopolitical analysts were not just watching the military response, they were watching something more important: the risk premium on India. Every time a missile flies in the region, global capital does a calculation, a cold emotionless calculation, and the calculation is simple. Is this market safe enough for my money? And then, as if the India-Pakistan tension wasn't enough, the West Asia conflict escalated in early 2026.
Dramatic scenes in the Strait of Hormuz, yet summoning the Iranian ambassador.
It's the price of oil.
The Strait of Hormuz was under threat. Oil supply chains disrupted.
Is now to the explosive showdown over the Strait of Hormuz. Iran
Emerging markets across Asia began bleeding capital as investors fled to safety in US bonds and gold. India got caught in two crossfires simultaneously, one regional, one global. Risk premiums moved higher, energy prices spiked, and the exit doors in Dalal Strait got very, very crowded. But there is a twist in the story, and this is where it gets really fascinating. While global investors were running for the exit, the United Nations released a report this week. They projected India's economy will grow at 6.4% in 2026 and 6.6% in 2027. The IMF has already recognized India as the world's fourth largest economy. The RBI governor, Sanjay Malhotra, is personally monitoring the FDI situation. He called these short-term fluctuations, not a crisis. And here's a deeper interesting point. Domestic institutional investors, Indian mutual funds, Indian pension funds, Indian retail investors absorbed nearly every rupee that foreign investors sold. The Indian middle class is for the first time in history acting as a counterweight to foreign capital flight. So is this a crisis, or is this a stress test that India is actually passing? In politics, we often say that history is written by the winners. But sometimes it's a response to the pressure that writes a real story. And right now, the response from India's domestic economy is quite remarkable. Now let's zoom out to the strategic picture, because the million-dollar question isn't just about the stock market, it's about something much bigger. Global capital follows three things: stability, returns, and story. For the last decade, India had all three. The story was irresistible. A young workforce, a tech-savvy middle class, and a government that was clearly countering foreign investment. The geopolitical shocks of 2025 and 2026 didn't kill that story, but they complicated it. Every global fund manager now has to answer one uncomfortable question to their board. What happens to our India allocation if the situation in Kashmir escalates further? And let me tell you, that questions once asked doesn't go away easily. The real risk for India isn't the FPI outflows of today. Those can reverse in a quarter. The real risk starts if global multinationals start rerouting their China plus one supply chain investments away from India towards Vietnam, Indonesia, or Mexico. That is the real $500 billion question, because those decisions are made in slow motion and they are very hard to reverse. So where does this leave us? India is at an inflection point. The fundamentals are strong, growth projections, domestic consumption, a resilient banking sector. But the geopolitical noise is loud and global capital is really nervous. To put it in a nutshell, coming months, the choice India makes diplomatically, militarily, economically will send a signal to every boardroom in New York, London, and Singapore. The question isn't whether global capital can abandon India. It already has, temporarily. The real question is, will India give it a reason to stay back? The answer depends less on what happens on the stock market and more on what happens in the corridors of power in New Delhi. We are a brand new channel and we are trying to build a community here that actually understands the intersections of business and geopolitics. If you found value in this video or if you have learned something new, please consider subscribing. Thanks for watching and I'll see you in the next one.